So, if you happen to look at your portfolio in early August, you probably saw a sea of red, right? Global markets just took this sudden, really sharp nosedive. And for a lot of us, it felt like it came completely out of nowhere. But what if I told you this wasn't random at all? That all that chaos was connected by this invisible financial thread, one that stretches all the way from a boardroom in Tokyo right to Wall Street. Okay, let's get into it.
Right, check this out. On August 4th, the floor just fell out. I mean, the Nikkei in Japan tanked a jaw-dropping 12.4%. And almost in perfect sync, the S&P 500 right here in the US dropped 3%, its worst day in almost 2 years. Now, these were not two separate things happening. They were deeply, fundamentally linked. The real mystery is, how?
And that's really the million-dollar question we're going to unravel here. What is this hidden mechanism that lets a policy change in one country create such a violent ripple effect thousands of miles away, smack dab in the middle of your retirement account?
To solve this global market mystery, first, we've got to understand this incredibly powerful, kind of hidden engine that's been secretly fueling global markets for the better part of 3 decades.
For years, a financial strategy called the yen carry trade has basically acted like a silent money printer for the entire world. Seriously, it's been one of the biggest, yet most overlooked forces pushing asset prices higher, from stocks to real estate, all across the globe. So what on earth is it? Well, put simply, the yen carry trade is when huge investors, we're talking hedge funds, big banks, borrow money in a currency where interest rates are practically zero, like the Japanese yen. Then they take that money and go buy assets in places where the returns are much, much higher, like right here in the United States.
And the way it works is actually surprisingly simple. It's really just a 3-step dance. Step 1, you borrow a ton of Japanese yen at almost no cost. Think near 0% interest. Step 2, you swap all that yen for US dollars. And step 3, you plow those dollars into something like a US stock or a bond that's paying out, say, 5%. Your profit? It's that difference. It's the carry. It's basically a giant financial arbitrage game played on a global scale.
And what made this trade a surefire bet for decades was this enormous gap in interest rates. I mean, look at this. While the US Fed had rates cranking up as high as 5.5%, the Bank of Japan was pinning its rate down near zero. It even went negative for a while. This huge difference was the engine. It created a virtually endless supply of cheap money.
And the sheer scale of this is it's mind-boggling. We're not talking about some small niche strategy here. Estimates suggest that somewhere around $1 trillion in global leveraged bets have been funded by all this cheap yen. This wasn't just a trade. It was a core pillar holding up the entire global financial system. But after 30 years, that pillar has started to crack. The Bank of Japan just made a historic pivot, basically turning off the cheap money spigot, and it's sending massive shockwaves through the whole system.
Now, this change didn't happen overnight. After decades of fighting deflation with these rock-bottom rates, Japan finally started seeing inflation come back. So, in March 2024, the Bank of Japan made its move. It officially ended its negative interest rate policy. That was the first rate hike in 17 years. By late 2025, the rate was up to 0.5%, signaling that the era of free money was well and truly over.
And hey, don't just take my word for it. This wasn't a decision they took lightly. The Bank of Japan governor, Kazuo Ueda, he put it pretty bluntly. He warned that if they waited too long, they'd risk a much more painful, much more disruptive adjustment later on. They saw the writing on the wall, and they decided it was time to act.
And that single action, it triggered a massive domino effect. The very foundation of that trillion-dollar global trade started to crumble, forcing a panicked, rapid reversal that traders are calling the Great Unwinding.
What this creates is a devastating double impact. Think about it. All of a sudden, the cost of borrowed yen is going up. At the very same time, the fear of this unwind is causing the foreign assets you bought, like US stocks, to go down in value. You get caught in what's called a negative carry death spiral. You're losing money on both ends of the trade, which forces you to just sell everything right now to stop the bleeding. So, where did all this cheap money actually go? Well, a huge chunk of it, we're talking 45%, was plowed directly into US tech stocks and other high-growth equities. Which, by the way, explains why that sector has been so supercharged for so long. The rest got spread out into things like emerging market bonds and commodities, and these are the exact areas that are most vulnerable right now. And this brings us right back to our aha moment.
Remember that chart from the beginning? Suddenly, it all makes perfect sense. The decision in Tokyo raised borrowing costs. That forced hedge funds to frantically dump their biggest carry trade positions, which were U.S. tech stocks, and that is what caused the S&P 500 to dive. We are seeing the direct cause and effects play out in real time.
You know, there's this classic saying on Wall Street, the road to hell is paved with positive carry. And what it means is that these trades, they feel so easy, so safe and profitable for years and years, and they lull everyone into a false sense of security. But when they reverse violently. And that's exactly what we're all witnessing right now.
So this great unwinding is probably not over. And that raises the critical question for all of us, right? What happens next, and what does this mean for your money? Well, if we look at the potential long-term impact, we can probably expect a lot more volatility in U.S. stocks, especially in those high-flying tech names that were basically fueled by this trade. The U.S. dollar itself could weaken as that big interest rate gap between the U.S. and Japan starts to shrink. And of course, the Japanese yen could keep getting stronger as all those investors are forced to buy it back to repay their loans.
Look, if you take just one thing away from all of this, let it be this: a fundamental engine of the global markets, a primary source of cheap money that propped up asset prices for an entire generation, is being dismantled right before our eyes. The rules of the game are changing.
And that leaves us with one final, absolutely crucial question. For 3 decades, the world's financial system ran on this machine. Now that the machine is being turned off, what comes next? That is the trillion-dollar question that every single investor is now facing.